Hello everyone. So today I'll be solving a question from October November O level accounts paper. This is paper 7707 paper 22 and this happened in October November 2021. You have 1 hour 45 minutes to complete this paper. I have done some previous questions of this paper as well. You can find them in my other videos. Today I'll be looking at question number 5. So question number 5 is focusing on the topic for depreciation, which is a very commonly asked topic as per our exams. So starting off with the question, Simon has business selling office stationery. On 1st January 2019, he owned 2 delivery vehicles which had been purchased on 1st January 2018. So the closing is that means 31st December, and he basically owns 2 delivery vehicles. They both were purchased on 1st January 2018. Delivery vehicle A had cost 30,000 and vehicle B had cost 25,000. Simon uses straight line method for depreciation. A rate of 20% per annum on cost is used, with the rate being applied for each part of the year. So this means that monthly depreciation is needed to be calculated, for which the delivery vehicles are owned. So whenever the question states that you have to the rate is being applied for each part of the year, this indicates that you need to calculate the depreciation on monthly basis. So when we are doing it on monthly basis, that means so how long this vehicle has been owned by the business, that is something that we need to keep into the consideration. Moving on, the question states, due to decline in business, delivery vehicle B was sold on 31st March 2020 and a check for 10,350 was received. Delivery vehicle A was still in use at the end of 2020. Okay, so they are disposing of motor vehicle B and they are receiving 10350 as a check for the payment of that vehicle. Now whenever we are disposing of the asset, we need to compare the amount that has been received, which is its selling price, and compare that to the net book value. So whenever the net book value is greater than the selling price, that means that you have sold it on a loss, and whenever your selling price is greater than net book value, that means that you have made a gain on disposal. Now moving on with the question, complete the following accounts for each of the years ended 31st December 2019 and 2020. Balance the accounts at the end of each year where appropriate. So starting off with 2019 January 1, the opening balance of 55,000 has been given to us. This 55,000 is 30,000 plus 25,000, because these are the 2 vehicles that were owned by the business. Now in 2019, this is 1st January 2019. During 2019, there was no change in any vehicle, because no new vehicles were purchased or none was sold. This was sold on 31st March 2020. So if we can, they have asked us to make this for both the years. So firstly we can simply write this off over here, and then we can start off with the second year, because the vehicle was sold in 2020 and this we are making this for 2019. So over here we simply write 2019, and now this date becomes 31st December, and we will write down balance CD. So balance CD will be 55,000, which is sum of both the vehicle A and vehicle B. Now we label this as 2020. So we write the same on both the sides. so 2020, and then the January 1st opening balance is the balance CD that we wrote over there, so this will become balance BD, which will be 55,000. So 55,000 goes over here. Now during the year they did mention that they sold delivery vehicle B, which was done on 31st March 2020. So we can simply write 31st March over here. Whenever we are selling or disposing of an asset, it the cost of that asset will be credited in the asset account, because delivery vehicle is a asset account and this is a debit natured account. This will increase on the debit side and this will decrease on the credit side. So whenever we are selling off any asset, it will go on to the credit side. So we can write this as delivery B, or we can write this as disposal. That would be better. So we simply write this as disposal, and disposal at the cost. So the original cost of motor vehicle B was 25,000. So we need to write 25,000 over here. Always remember, when we are making the asset account and we are making an entry for any disposal or sale of asset, we always write down the cost of that asset at which it was acquired under the asset account. Now once this is done, there was no further addition, so the next step would simply be to balance off these accounts. So this totals to 55,000, and the same amount will be written over here. So we write 55,000, and deducting 25,000 from 55,000, the difference is of 30,000. So this is your balance CD, and this amount is 30,000. Now dates are important when you are doing these questions. So the date over here will be 31st December, because this is happening at the last date. And to show balance CD as balance BD, you simply show this down on 1st January 2021 as balance BD. So now the new balance in the delivery vehicle account is only 30,000, because like we only have one machine. So this is simply your delivery vehicle account. Moving on, the next part of the question is saying to make a provision for depreciation account. The opening balance has been given to you as 11,000. Now again, you need to keep this in mind that provision for depreciation account is a credit natured account. Whatever increase is recorded on the credit side, and any decrease is recorded on the debit side. So again, over here we need to do this for 2 years, because the question is the same. They asked us to do this for 2019 and 2020. So for 2019, we do know that the balance on the assets was 30,000 and 25,000. The total cost was 55,000, and they were charging depreciation on a straight line basis on 20% on cost. So to calculate the depreciation amount, simply we can write down this as 31st December, and we can write the amount all together. So we just write income statement, and this income statement value. So income statement value, we can put this in two parts. We had motor vehicle A and motor vehicle B. The cost for motor vehicle A was 30,000. So 20% of 30,000 gives us, so we know that 30,000 multiplied by 0.2 will give us 6,000, and so this is, let's say, 6,000. And for motor vehicle B, the cost was 25,000, and again 20% on 25,000 will be 5,000. So motor vehicle B is 5,000. Now once we add them up, we get the total amount of 11,000. So income statement figure that we gonna put in the income statement in terms of expenses, provision for depreciation, that is 11,000. Now if you simply add them up, this becomes 22,000, and the same amount will go over here, 22,000, and then we will show the balance BD, balance CD, which will be the balance brought down, and this is 22,000. So this will be the new balance for 2020. Now remember, in 2020 they were selling off motor vehicle B. Whenever we are selling off any asset, any depreciation that has been appearing in the books related to that asset must be written off. We do that because that asset is no longer a part of our business. So any depreciation in relation to that particular asset must be written off. Now, keeping one thing in mind, they did mention something about charging depreciation on a monthly basis as per the time period that you are holding the asset for. So we sold this motor vehicle B on 31st March. The year is starting on 1st Jan. So suppose Jan, February and March, we know that we use that asset for 3 months. Now if you are using that for 3 months, that means you need to record its depreciation also for 3 months. And other than that, the total depreciation for that vehicle will be written off. So calculating, we can calculate this as 31st March. Now this is the income statement amount for motor vehicle B, and this amount we can simply, now we knew that 5,000 is the charge for the whole year. Now in order to calculate the amount for 3 months, you simply take that amount 5,000 and multiply it by 3/12. Why are we doing 3/12? Because 3 months depreciation we need to record, and 12 are the total months that are in the year. So the amount that we gonna get, so this is like 5,000 into 1/4. So 1/4 of 5,000 is 1250. So the amount of 1250 should be recorded in the books as the income state, as the expense for the depreciation that was charged on motor vehicle B. Along with that, motor vehicle A is still with the business, and that will be, because this was a straight line depreciation method, this will be 6,000 like previous year. This is the same amount. Now we come to the part of, and this is being done on 31st December, let's say. So over here we will be recording the disposal value, because as we are selling off the motor vehicle B, we need to write off its depreciation. So the total amount of depreciation that has been charged on motor vehicle B so far has been, first you need to calculate how many years this was with you. So there was this amount where we took this 5,000. There was this amount in relation to that vehicle B, and of course there was this 11,000 initially, which was made up of 5 and 6,000. So there was this 5,000 over here also. So 5,000 plus 5,000 plus 1250 makes up the total depreciation that has been charged on this vehicle so far, which is 11,250. Why are we taking 2 and 3 months depreciation? Is simply because these vehicles were purchased on 1st January 2018. So from 1st January 2018 till 31st December 2018, that is 1 year. Then 1st January 2019 to 31st December 2019, that's 2 year, and then you had this till March for 2020, so that is like 2 years and 3 months. So the total depreciation that was charged on this vehicle was for 2 years and 3 months, and that total amounted to 11,250. Now we will be recording this on the debit side, because whenever we are disposing of any asset, its total depreciation, its total accumulated depreciation so far which has been recorded in the books is written off. That means it is removed from our provision for depreciation account and it is recorded on the debit side. So now simply totaling this amount, so 22,000 plus 6,028 and 29,250. So this is 29,250, and the same amount goes over here, 29,250, and from 29,250 if we deduct 11,250, we are left with 18,000. So the new balance CD is 18,000. That means that now this is the balance that will be carried forward to 2021 as your balance BD in your provision for depreciation account, which is 18,000. So this will be your complete provision for depreciation account showing year 2019 and 2020 both. Whenever we have a balance CD figure, we need to show it as a BD figure in all the questions. Now moving on, the next part is where you have to make the delivery vehicle disposal account. Now a lot of students ask me many times that a simple format for disposal account. Always remember, the very first thing that you record on the debit side is the cost of the asset that you are disposing. So the cost of the asset goes on the debit side, and then the depreciation for that asset goes on the credit side. The amount that you are receiving in terms of the selling price, that goes on the credit side. So this vehicle was purchased for 25,000. Now remember, all these entries that we wrote disposal, this was appearing here on the credit side, and this is the same amount that will appear under your disposal account on the debit side. So this 25,000, the cost of the asset that we have been selling, that goes here, and then under the depreciation we had this part where we wrote disposal of 11,250. So this is the depreciation that is being charged. So this amount will go here, because like this 11,250 was debited in the provision for depreciation account, and this is being credited over here. So the amount for depreciation, and under the bank heading you need to write down the amount of how much you received in terms of that particular sale. So, they received 10,10350, 10,350. So, this amount will simply go over here, 10,350. Now, once this is done, you need to total sum up the larger side. So, we can see that this is the larger side adding up to 25,000. The same amount goes here, 25,000, and we deduct the difference. So, 25,000 minus 11,250 minus 10350, that will give us 3,400. Now, this 3,400 is loss on disposal of your asset. So, there is a loss on disposal of 3,400. Now, always remember, there is no balance CD or balance BD in a disposal account. In a disposal account, you are simply calculating whether there was a gain or loss on disposal. This amount of 34,000 is the amount that will go in the income statement on the debit side, because this appears here on the credit side. So, in the income statement, a loss on disposal is always recorded as an expense, and it is recorded on the debit side. However, if this side would have added up to be a larger figure, suppose this side would have added up to be, let's say, 30,000, and then we would have written that 30,000 over here, and the difference would have been on the debit side. And in this case, whenever there is a difference on the debit side, that is considered as a gain on disposal, and in your income statement, a gain is always added up into your profit, and that is done on the credit side. So, you can clearly see that that amount would have been a gain. So, any gain on disposal is the difference that is appearing on the debit side, and any loss on disposal is the difference that is appearing on the credit side. There is no balance CD or balance BD under a disposal account. So, our disposal account ends over here. We have calculated that there was a loss on disposal of 3,400 in selling this motor vehicle B, because you sold it at a 3,400 less than what the net book value would have been at that date. Now, moving on to the next part, Simon's sister Yasmin is also in business and depreciates her delivery vehicles by reducing balance method. Simon is considering whether to apply reducing balance method of depreciation to his delivery vehicle. Advise Simon whether he should apply the reducing balance method. Justify your answer. Now, this is for 5 marks. This is a pure theory answer. You can simply give the benefits of using reducing balance method. In order to answer this, you can simply give your reasons and benefits on the uses of reducing balance method. Now, reducing balance method is more applicable in a situation where the asset loses more of its value in the initial years. Balance method, you calculate every year's depreciation on the basis of its net book value. This is more suitable when the asset loses its value more in the initial years, and this is also considered to be a more realistic view of the book value. And sometimes it is a little complicated to calculate as compared to the straight line method. However, you can also mention about the benefits of a straight line method, that it is easier to calculate, and you have the same amount that is to be used in terms of depreciation each year, and it is more suitable when annual use of the asset is evenly spread all over the year, and you can use a straight line method under that situation. So, I think so this question ends over here. I hope you guys find this helpful. Please do watch my other videos as well, in which I have solved other questions. Do leave your comments in the boxes below. Also, please do leave any request or any specific questions that you would like me to help you go through and help you solve them. Thanks for watching. Take care. Goodbye.